Shareholder Primacy from Free Float Media, a podcast about activist investing, securities law, and all the ways the financial and legal worlds intersect and collide in real life. We're together with Ann Lipton, law professor at Tulane in New Orleans, who teaches and researches securities and business law. She holds up the legal end of this little podcast.
And that's Mike Levin, an activist investor who lives and works in Chicago. He covers the financial side of our podcast.
Let's this week talk about a couple of fun subjects. First, there's been some interesting developments, news about how and why companies, private companies, stay private and keep raising capital, attracting money, and sort of not go the IPO, initial public offering route, which was sort of the traditional kind of denouement for most companies. So we'll talk about that.
And we'll dive into rational apathy, a subject with both academic and practical applications.
Alrighty. Let's begin with this idea of public or private companies. It's been a longstanding debate, of course, about when and if and how a private company that gets big and successful enough should basically expose themselves to public money. And most recently, in the last few weeks, David Solomon, who is the CEO of Goldman Sachs, said in a public statement or an interview, there's just no need for IPOs anymore. Mm-hmm. They can just stay private, which I'm sure made the bankers at Goldman IPOs a little nervous. But like, is this true? Let's dive into that. Is there a need for IPOs anymore? Or is that a thing of the past?
Yeah. So I mean, as you know, we have the Securities Act of 1933 and the Exchange Act of 1934. They were passed in the wake of the 29 market crash, and these laws say if you sell stock to the public, you need to start filing regular disclosures with the SEC. And of course, These are very comprehensive reports. They have details about your financial condition, your business operations, your capital structure, and so forth.
10Ks, that kind of stuff.
Exactly. And it can be very burdensome for a company. It's expensive. You have to disclose competitively sensitive information. You risk liability if your disclosures aren't accurate. But the law doesn't require disclosure for private sales, which leads to the question, what is a private sale? Because what
defines a private sale?
Exactly. So what's happened is that over the past 30 years or so, Congress and the SEC have tinkered with the securities laws in a way that really broadens the category. So it used to be, if you were a private equity fund or a venture capital fund, if you wanted to stay private, you couldn't have more than 100 investors. In 1996, they lifted that cap. Now it's basically 2,000 as long as the investors are high net worth. So it's a lot easier for a single fund to raise a lot of money while staying private. And that means that if you're an operating company, you can get all the money you need from like one or two funds. Since each fund only counts as a single investor, that also looks like the company is just raising money from a small circle of people, from two investors, and those sales count as private as well. So as a practical matter, you can be aggregating that capital of hundreds or thousands of investors, but the investor buys shares in the fund in a private sale, the fund buys shares in the company in a private sale, and voila, no public disclosure. So the law has also changed to make it easier for companies to pay employees in stock without triggering public disclosure requirements, because otherwise that would be a sale to the public, but it's not treated as such. So companies can have a large number of employee investors and still be considered private.
So stop right there. So the idea that you've got your LPs or your investors and so forth, they could be stockholders. That's one kind of dimension to public ownership, or how many people own it before it's declared to be public and has to register and do all these disclosures. But when you start paying, and some of these companies can get pretty big, hundreds or whatever number of employees in stock.
Exactly. You can start paying, and the law basically makes it much, much easier to do that without calling it public. So now you have all of these employee investors, and then the rules have also made it easier for private company investors to trade their stock among themselves. It used to be that, okay, fine, you can invest in the company, but you can't really easily resell your shares. Right. So that made it made it investors hesitant to invest in the first place. Not anymore. Congress and the SEC have made that much easier too. So the combined effect is that over the past few decades, it's become easier and easier for companies to raise staggering amounts of capital and become very large and influential without any accompanying disclosure. So these days, why companies go public isn't really to raise capital. They can get as much capital as they want. It's because insiders either want to cash out in a way that even private trading won't accommodate, and that is becoming a smaller and smaller category, or the company wants to make acquisitions using its own stock as currency, and so then it finally needs the stock to have a public valuation.
Oh, okay. So, yeah, normally the decision in whether to have an IPO or a public stock was because we needed the money.
Right, but that's not
capital.
Yeah, but because and this is because the SEC lets all of these, and Congress essentially lets the aggregation of a lot of people's money, but still call it only one investor. So it doesn't count towards, being a public sale.
Right. All right. So then we get back to these other couple and you didn't mention kind of vanity.
Yeah, well, vanity. Fair enough.
Activists frequently refer to vanity listings or companies that are public and should be private because of some of these expenses and so forth. But that's for a different day. But then the two main reasons would be, second, you mentioned for being able to use your stock in transactions to buy other companies. And then the other reason was
cashing out, which again, but the SEC and Congress have made it easier and easier to trade privately. So you really have to reach a point where even that's not sufficient for somebody who wants to cash.
So employees. So you have employees that have a lot of their net worth.
Yeah.
Individual employees tied up in their company, and they say, "I want to diversify my portfolio or something."
And the company will have these events where they'll let them trade and sell to other investors. And again, this is all considered private, essentially because of tweaks to the securities laws that have happened over time.
Right. And interestingly, because it's all private, it's kind of outside of the purview and scrutiny of the SEC.
That's
that's a problem, I think.
Yeah, so this is what
you're driving at. Okay.
Yeah. So I mean, some people take from this that it's unfair that under the rules, companies can only do this if they limit themselves to wealthy investors or wealthy investors and employees. So
like accredited,
or okay. Sometimes it depends on which rule you're talking about. There are qualified purchasers, there are accredited purchasers, there are qualified institutional buyers, but ultimately people with a lot of money or institutions with a lot of money. So one argument is that we should let ordinary people invest in private companies as well. And that is not my takeaway. My takeaway is that we're rapidly losing insight into the economy. And I think that has really deleterious effects. So when you go out and you value a company, you do that by looking at stock prices. You look at the stock price of similar companies. You look at the capital asset pricing model. But either way, you need stock prices. But now a lot of stock prices are out of use. So the models that everyone uses kind of become less accurate.
And the reason they're out of view isn't because we can't see them. It's because they don't exist.
Yeah. It's because there's no real market. I mean, you can sometimes get some secondary market trading data, but it's just nothing like an efficient market. And you don't have an income statement. You don't have a balance sheet. So in these private
or you don't have a public information.
But very often there's no information even to some investors for some hot companies. They get nothing.
Oh, that upsets me. That happens to me sometimes where I'm in a private company and
no information.
Right.
And in these private markets, you can't short the stock. It's very hard to express negative sentiment. So that facilitates bubbles, which isn't just a problem for the investors in those companies. It's a problem when those companies collapse because there's a blast radius. My big example of this is WeWork. WeWork was so overvalued due to a lack of information that when it finally imploded, it disrupted real estate markets on 2 continents.
Yes. Yeah. No, that was a big disaster
for everybody, everyone who
for
touched
employees, for real estate, for the tenants.
Exactly. So this is a problem for investors, but all this secrecy, it's also a problem for everyone else. So think about it this way. When a company has to make these comprehensive disclosures, it's not just investors who see them. The entire public gets insight into how the company works. So competitors read them, so maybe we get more competitive markets. Labor reads them. They demand higher wages. They bargain based on this. Consumers read them. I mean, probably not consumers directly, but definitely consumer groups.
Customers, right? Yeah, right.
And they can make judgments about whether this company is somebody they want to do business with, and regulators use them to get basic insight into the economy. This is a great story. Airbnb stayed private for this really, really long time, even though it became bigger than some of the largest hotel chains in the world.
Right.
To the point where, I swear to God, local officials started paying one random guy to scrape its website just so they could get a sense of what land use looked like in their area.
Oh, wow.
And so
they used to have that from like public disclosures.
Yeah, exactly. But
right,
they don't have it when it's private. So, and also, this is really like fuzzy, but when a company knows that its internal operations are open to public scrutiny, I think that kind of professionalizes their behavior. Like CEOs, boards of directors, when they're a public company, I think they understand in a general way that they have to justify their choices to the public, and that constrains what they're willing to do. So I think, honestly, this explains a lot about startup culture in Silicon Valley. You have these companies that got very big and very powerful and operated entirely in a black box, and they developed their own move fast and break things ethos, and then that kind of extended outward even when they went public eventually. So we've talked about shareholder agreements several times. Under Delaware law, until recently, it was understood you couldn't have shareholders just contract to control major aspects of corporate functioning. Boards of directors needed to maintain their discretion about how to run a company. But in these private companies, shareholder agreements became common even after lawyers warned their clients they might not be enforceable. And the companies were private, so no one saw them.
No one cared at that point because you were private and you didn't have public shareholders that you had this fiduciary duty to kind of look over this contract.
It was all private shareholders. It was employees who worked for the company. They're not going to challenge anything. And then the shareholders who agreed to it. Then the companies went public. But by the time they did, and by the time these agreements were challenged, they were so common and such a powerful ecosystem had kind of grown up around them that the companies were able to muscle through changes to Delaware law to retroactively make them legal. So I think that's
that was the Moelis. That was the whole Moelis thing, right?
Yeah, exactly. That which we did a whole show. And so that's the thing that happens when companies grow to enormous sizes without any public scrutiny.
Right. And in this sense, the public scrutiny is a valuable, critical almost byproduct of this kind of decision to take public money.
Yeah, exactly.
Okay.
It comes to this group. In academic terms, we call it a positive externality.
Positive, right. Well, in economic terms too, that's an externality.
Really? Yeah. Well,
right.
Yeah.
Okay, cool.
I don't know how it goes. But there's actually, so this is the best part. There's actually this really interesting history. The idea that big companies should be subject to basic disclosure so that the public knows what they're up to, that idea has been around for over 100 years. So throughout the early 1900s, when we first saw the rise of massive corporations, there were a lot of proposals to require that all companies make basic disclosures to the public as a means of controlling them. So there was testimony before Congress in 1913 where someone said, and I'm quoting this testimony in 1913, "I think any man who has been abroad as much as I have and seen the difference between a young man, the way they behave at home and the way he behaves in Turkey, will agree that a little publicity, the watchful eye of a friend there, is a very powerful influence in making him decent."
Who was it?
I don't remember. It was like an academic testimony for Congress.
It was testimony before Congress. Okay.
Yeah, to make all these, because there were all of these proposals for general corporate disclosure. It was viewed as this really important tool to regulate corporate behavior. But when that got translated into actual legislation in 33 and 34, and this is, remember, FDR ran on a campaign challenging the princes of property. Controlling corporations was a really big theme at the time. But when this idea got turned into legislation, the legislation was not disclosure for the public. It was disclosure for investors.
For investors, for shareholders.
Only information that investors need, on the theory that maybe it's aimed at investors, but it's still available to the public. Except today, we have a real question of what happens when investors are wealthy institutions and don't need disclosure, but the rest of us still kind of do.
or can sort of tailor. One investor may say, "I want this." Another investor may say, "I want something different," and so forth.
But tailor it in these private markets where nobody else can see
but it's all private demands.
Exactly. So they don't need mandatory disclosure anymore.
Wow. It's funny. I hadn't really thought about these kind of second and third order ramifications to this, to what Solomon was kind of hinting at here about no more IPOs. No more IPOs, and I say, as an investor, I'm not an IPO investor. I'm not big enough. I'm not important enough to get allocations that way. But even so. From an investing standpoint, I don't love hot IPOs anyway.
Yeah.
I think the governance in IPOs kind of is pretty deficient. Because it's still kind of founder based. It's designed to protect. That's where a lot of the dual class stuff comes from.
Yeah,
and so
that's
but in terms of the ramifications of fewer IPOs. Okay, great. There'd be SPACs or I don't know, whatever. Okay, but this kind of, as I said, second or third order implication for lack of just transparency and disclosure about what's kind of going on, as you say, going on in the economy.
Yeah, I mean that's
pretty interesting.
That's what worries me. And I mean, and the thing is that in the Trump administration, I think we're moving in the wrong direction. I think Trump's SEC is actually going to make it even easier for companies to just stay private.
Yeah.
So there's a really interesting story though in Europe, because Europe recently adopted legislation called the Corporate Sustainability Reporting Directive, or the CSRD. It requires companies to issue these extensive reports on their environmental impact, labor relations, human rights impact, consumer impact. It's supposed to phase in over time. Some of those requirements are just kicking in now. So all these companies have to meet the CSRD reporting requirements. And when you read news about it in the American press, it's treated as though this is just ESG reporting, really, really extensive ESG reporting. But what is getting missed here is that the CSRD is explicitly intended for non-investor audiences. All of this ESG information that companies have to disclose is intended for consumption by the general public. It's explicitly for unions, for NGOs, for voters. That's who the information is for. And because of that, the CSRD applies not just to companies whose shares are actually traded in Europe. It applies to any company that has operations in Europe and is big enough to have a social impact. It applies to big companies, not just publicly traded companies.
Public companies, okay.
Exactly.
Wow.
So it's this throwback to the original ideas of the progressive era that big business can be like a political threat, and the companies can have as much power as governments, and we should require that they operate with a certain level of transparency, just like a democratic government. But, of course,
I don't see that happening here. Go ahead.
It's not happening there either, because there's been all this pushback. It's like it's just being phased in now, and some countries are already being like, "Oh no, this is too burdensome. This is too much," and already they're seeking to amend it and possibly dial back a lot of the requirements. So I don't know if the CSRD is really going to survive, at least not in its current form. But they were trying. They were trying to get at this problem of it's not about just investors, and sometimes it's worth it to the public to have information.
Right, but let's go back to sort of a quick question, which is, the SEC with all this disclosure, and again, the two main planks of the SEC's work to protect investors is registration and disclosure. So we know what's going on, so they know what's out there, and there's a certain level of disclosure, and we're talking in a really interesting and a fascinating way about the disclosure aspect of that. I mean, the general public's nice. But isn't the SEC really supposed to just protect investors?
Yeah. Oh, it absolutely is. Okay. It absolutely is. So, if it were going to, I think that disclosure for the general public is sort of outside the SEC's mission. And I think that if we ever were to get something like that here, it wouldn't necessarily come out of the SEC. It would actually, it might even come out of the FTC, which was originally supposed to be the SEC. Before there was an SEC, the 33 Act assumed this would all be handled by the FTC. So, but and politically, none of that's happening right now.
I think there's bigger priorities in Washington right now, but
I think that it's it's been a problem. It's been a growing problem over time.
Right, and so and it's exacerbated and symbolized by what Solomon said. Yeah. Last month or last week or whenever it was. Wow. I hadn't thought about, like I said, these kind of second order, these kind of deeper implications of this are really kind of interesting. I'm glad, so, all right. I think we might want to give people a break here for a second. There's a lot to consider. So let's do that. We're going to take that break right now and return in a moment to talk more about rational apathy here at Shareholder Primacy.
Shareholder Primacy is brought to you by FreeFlowAnalytics.com, the only free database of corporate directors, their influence, and their performance. If you own a stock or retirement plan, go to FreeFlowAnalytics.com and look up which of your elected directors are performing well and which aren't. Use your vote in the alternative democracy and get your data at FreeFlowAnalytics.com. Now, back to the show.
Welcome back to Shareholder Primacy. I'm Ann Lipton here with Mike Levin. So, Mike, let's talk about rational apathy. What do we mean by rational apathy?
What do we mean by what do you think we mean by rational apathy? I mean, it's really kind of a subtle term, but rational apathy. What's your 2-second reaction?
There's things that it's just not worth it for me to care about. That it's not like, for example, when I don't know, download a song from Amazon, I do not read the terms and conditions. I'm telling you right now.
Oh, absolutely.
But they could be saying something like, I gave up my
really
firstborn. I'm just hoping
there was
they
also,
don't.
There was it's funny, there was the cartoonist Scott Adams used to have a bit years ago when I used to read him. He's evolved, where the main guy Dilbert used to download that, and at one point he became Bill Gates' towel boy.
Actually, there are companies that hide little things like the first person to read this gets $100,000.
That's right, right.
Yeah.
Little Easter eggs in their terms and conditions. All right, so you're absolutely right. That it would be you would be rational to be apathetic about the terms and conditions about downloading music from
for the 99-cent song, it's not worth spending an hour reading the contract.
Right. Well, there is an analog here to investing and to corporate governance, which is that it makes sense, despite what a lot of people jump up and down to argue to the contrary. It makes sense for a lot of investors to not care about voting. And it really upsets people about voting. Voting on at annual meetings. Mm-hmm. Okay, so when the rational apathy we're going to talk about here culminates in whether shareholders of a U.S. public company vote their shares. They're entitled to vote their shares. There's lots of people who run all over the place and say, you're an owner.
Right.
You should be able to vote. You should care about this stuff. And a lot of shareholders say, huh?
Right.
I don't.
Right.
And in fact, that is rational in the strictest Enlightenment sense of a reasoned way to behave. And that's what I would want to be interested in exploring. You were going to say something for a second.
Yeah, no, I mean, I just know that there have definitely been situations where companies had really needed retail to vote to get something done. Like Tesla reincorporating, or Disney.
AMC approving.
Disney's
trying to get a quorum.
Actually creates great materials for corporate law professors, because when those companies reach out to retail, they try to do things that is going to attract retail attention, which then gives me a really great classroom example. Like Disney made a little video.
The video. Did you play that video?
I saved it. I played it for my class. I played it for my class.
Oh, no kidding.
Because they're trying to excite retail and get retail interested in
Scrooge McDuck telling Disney voters to support Bob Iger.
And he explains how to go about voting. It's a great classroom tool.
Okay. So that's a great example of how companies sometimes necessarily have to try to fight rational apathy.
Right.
But why rational apathy kind of exists is really kind of interesting. So it's been around the idea has been around for a long time. It was like Berlin Means, our two founding scholars of corporate governance and ownership and control. They called it passivity rather than apathy. But they kind of identified it in their work in the early 30s. And there was a more recent manifestation of it that a law professor kind of wrote up. And I love the definition. She said it was rational decision making by utility maximizing investors, and therefore a good and efficient thing. And those tugged at my heartstrings. She also said it's
which professor is this?
I can't remember. I'll have to. It was Sarah Hahn at University of Virginia. So she wrote that. But she also referred to the person as doing it was explained by incentives operating on Homo economicus. And I was so gratified that a law professor was referring to Homo economicus, who was born at my graduate institution, the University of Chicago. Anyway, there's been a bunch of research over the years about what rational apathy kind of means and how it works. There's actually not been a ton when I looked around to try to see if there's not a whole lot of papers, but there's been a few. A couple folks who were at our favorite Harvard Law Corporate Governance Center, Kobe Castile and Yaron Neely, did some really good papers on this. Anyway, it saddened me a little bit that mostly it was legal scholars.
Oh, it's not really a thing in a.
There was,
I didn't
I mean,
realize.
it's there's a little bit of research in the financial and economics journals, but mostly it was law review papers.
I see.
Anyway, so that was the whole founding idea about what this is, and so there's some observations that I wanted to kind of make, or I took away from a read of this. First is that rational apathy kind of arises from something very economic, which is a comparison of benefits and costs.
Right.
What's the benefit of an individual shareholder voting, at one share?
Right, because the individual
their
shareholder's got a
holding.
tiny stake. Their vote
Exactly.
doesn't make that much of a difference.
You're not going to have that much of an impact.
And they have to put in a lot of effort just to, read the proxy material.
Exactly. And then one of the scholars actually had a very elaborate model about the cost, about trying to identify the costs and benefits. And so there's kind of two kind of costs that were worth kind of observing. The first was the actual cost to become educated about the subject of a vote.
Yeah.
Okay. A lot of this stuff's really arcane. Trying to get educated about what the directors, which directors make sense, and activists or companies,
Just even to know what the
voting about
issues
this.
are. Yeah.
I'm sorry.
Yeah, even to know what the issues are.
What the issues, voting on an equity plan and so forth. That's also where, where the proxy advisors come in. They kind of try to lower that information cost for you, or convert it to money. So you just pay them, and they, you trust them. There's a whole economics to that. But so there's a whole cost to trying to get up to speed about what you're voting on. Okay. And then the second cost is the system, just trying to navigate the system of voting. The whole proxy plumbing and so forth. Where's the proxy card? Which color? How does this work? What's my control number? There's a whole very, crappy system for voting that is also a cost. And so those two costs kind of together add up to the cost of voting. And again, the benefit is that it's most shareholders, even institutions, have a negligible impact. They're marginal. I mean, it could matter in a really close kind of
Right. Well, it matters, especially in these
contest.
companies that have lots of retail. Like, not every company has the same shareholder base, and there are a lot,
Exactly.
especially the consumer-facing ones that have this lot of retail.
Right. So most of what I saw and what I thought about in terms of rational apathy addresses basically how to lower the cost of voting rather than kind of increasing the benefits.
Okay.
Okay. So, making information more accessible and clearer. That's, again, where the proxy advisors come in. Or trying to make the voting process a little easier seems to be the effort to try to deal with rational apathy and to try to make it less of a problem. Now, another interesting observation is that you'd sort of think that this is mostly a problem that's confined to that of individual shareholders. Mom and pop, widow and orphan kind of thing, right? They don't know where to read a proxy and how to vote a proxy. This is also a problem for institutions.
Oh, okay.
Okay. The idea applies equally to them. That again, most of the analysis is to try to encourage. You heard Tesla we talked about them. Tesla trying to get all the individuals out there, but even institutions like with significant holdings. They may have a little more of an impact than a single shareholder, but they still have the same problem of trying to get up to speed, especially because they're going to have a lot more holdings probably than the usual
Right. So they're going to
individual.
do this several times a year.
Okay,
Or a whole bunch at once.
Yeah, right. But they're probably a little better able to navigate the cost of casting a vote. Mm-hmm. They're the ones who pay. ISS or Glass Lewis not only for voting advice but actually to cast the vote. Mm-hmm. But nonetheless, this can be a problem for institutions as well. So then the last kind of interesting factor here was that size of a holding. Okay, you know,
Right.
normally, the extreme edge case of, one person owning one share in an enormous company, of course they're not going to vote.
Yeah.
Okay, that is totally rational to be,
Right.
you know, apathetic there. Okay, but as size of holding increases, it sort of makes at least the benefit a little more relevant here.
Right.
Okay, and we can talk about size of holding sort of in two ways. First, the obvious way is size of holding as a percentage of the company's outstanding shares. Okay, so my one or whatever share is one thing, but if you're BlackRock and you own 15% of some company,
Right.
that may be really impactful.
Right. So
Okay,
yeah,
and
the larger you're holding, the more likely your vote is to make a difference.
Exactly. Okay, but there's another aspect to this too, is how much of the investment in the company, what percentage of the investment portfolio
Oh, right.
it is there. Okay, so if you own a tiny percent of a company, but nonetheless it's a big part of your investment portfolio, you still may decide to kind of get up to speed and figure out what the issues are. Try to overcome the cost
Right.
of voting.
Because it matters a lot to you.
Right, exactly. So those kind of two issues interact. So if you're an institution, as we said, this rational apathy can be a problem for institutions too, and it becomes one where the percent of the company is big enough and the percent of your portfolio is big enough, you'll figure out a way to vote. You'll overcome that apathy, or
Right.
it'll become rational for you to figure out what the issues are and how to navigate the voting system. So anyway, once you start to think about rational apathy in this way, it becomes very much more of a factor in how you see problems. So like we talked about the proxy advisors,
Right.
ISS and Glass Lewis, they exist to overcome rational apathy. That's one explanation of their whole business. It reflects back then on how there's certain regulation, SEC or Department of Labor regulations that require pension funds to vote. Okay.
Well, it doesn't really require. It just strongly encourages.
It encourages.
Although
because it says,
I rather suspect that'll change in the new
right. It says
administration.
it says that the vote is a plan asset, and they need to
exactly.
exercise fiduciary duty over that. But it can become rational for you to say, okay, this isn't a big enough deal to me, and I have to now explain. Okay. Or
Right.
conversely, the SEC came out with regs 2 or 3 years ago that essentially allowed funds, not necessarily pension funds, but like hedge funds, to affirmatively not vote shares, and particularly to not recall lent shares.
To lend shares out for vote and not recall them.
And
for
not
vote
recall them to
if
vote.
it's not worth it.
Right, because it was rationally, economically better for them to collect lending fees
Right.
than for them to vote. So anyway, this comes up in all sorts of ways. Pass-through voting is intended to try to overcome rational apathy, and Vanguard. There was a news item a few weeks ago.
This really
month or two ago,
it's
about it's not going
so that
anywhere.
Vanguard doesn't have to take a stand on all the social issues that proposals
Exactly,
come
but on the other hand, it didn't. It made no one else cared either. So their pass-through voting wasn't. There's all sorts of other.
It's only been a year. We don't know.
Oh, fine. Okay. So there's lots of other innovations, and if you start to kind of look at them through the lens of this rational apathy thinking, it starts to make a little more sense.
Right.
And so that kind of fascinated me at the time. Right? I read some of the papers, and it was kind of fun. And it was really, in some way, a really kind of ideal intersection, as we've said about the theme of what you and I talk about, intersection between law and the economics part of it. About how the laws, try to encourage one thing or another, and the economic behavior tries to counteract it or reinforce it. So that was rational apathy. It was kind of interesting to learn about, and to put a name on something we've been observing all along. So that was it.
Oh, that's great.
Anyway. I think we've done this plenty for one day, don't you?
Sure.
So let's wrap up. Ann, it's been wonderful talking about all these subjects. This is Shareholder Primacy, hosted by Ann Lipton and me, Mike Levin. I'm an independent activist investor and advisor to investors. about their activist situations. Ann is the Michael M. Fleischman Professor in Business Law and Entrepreneurship at Tulane Law School and an affiliate of Tulane's Murphy Institute. You can find me, Mike, at theactivistinvestor.com and Ann at law.tulane.edu. Our podcast is produced and distributed by Free Float Media. Thanks for listening, and we will talk again soon.